Hey, welcome everyone. This is Larry Bailey, your host for today with June 7th, live with Chaley. Unfortunately, Chaley is currently out of commission. She is down and out, a little bit ill. We're all giving her her best wishes. Today's meeting is brought to you by Ridge Lending Group. Just as always, we want to say thank you very much for sponsoring these events and also for the Ridge Lending Group community. If you have any questions, anytime you need any help with regards to residential financing or commercial financing or construction, you name it, check out ridgelendinggroup.com. Feel free to call 8885. I'm sorry, I can speak. You can always call at 855-74-RIDGE or info@ridgelendinggroup.com. I can figure it out here. So we're going to go ahead and keep admitting. And today is all about figuring out how to qualify for your next real estate investment or cash out. And the reason why I'm focusing on this today for qualifying is because we've seen over the last couple of weeks, we've seen borrowers who either are completely overqualified, if there is such a thing, but they have no problems qualifying for a new loan, even if they only make maybe $30,000, $40,000, $50,000 a year. It doesn't sound like a lot. It's like, well, how can somebody qualify for a property? I make 2 or 3 times that, and I'm having trouble qualifying. So we're going to go through those ideas, those calculations from a lender's perspective, because as always, it's not always what you think is happening. So I thought it might be really good to kind of peel back the curtain here, like I like to do, and help you understand what's going on. So what I'll do is I'm going to share a screen. If I can do this properly. I know Zoom is a challenge for me sometimes. So if everybody could either give me a chat or a thumbs up or something, let me know that you can see the screen okay. You'll see something that says Ken Customer on the upper left side. If everybody lets me know that that's what you're seeing, excellent. Thank you very much, Norman. So, so what you're seeing on screen right now is a piece of software called Encompass, ICE Mortgage Technologies, which is also owned by ICE Intercontinental Exchange, which also owns the New York Stock Exchange, as well as a bunch of other things. It's a multinational conglomerate, bigwig kind of a place. And the software is not a bigwig kind of a thing. It's actually pretty old software, but it powers a majority of the mortgage transactions across the country, believe it or not. Just a silly little program here. So the big important reason why this is, I'm bringing this up and I'm putting this on screen, is because I want to, again, share just enough information where it makes sense. Again, Ridge Lending Group is always about educating borrowers. And so we want you to understand the basis behind qualifying so that A, you're informed, B, you don't get bad information from someone else, C, when you're ready to go, you'll understand how to self-qualify, and that'll make your process a lot smoother for making some really personal choices and decisions as to whether or not you should even think about investing or real estate investing into the next transaction. There is math involved, so if you don't like math, sorry. I know you do like math because you're in real estate investing and you like seeing more zeros at the end of your account. So I know you like math, but I'm just giving you a heads up. A couple of baseline terms that I want you to understand and remember. Some of these you might have heard before, but the first term is loan to value, or LTV, and the second one is DTI, or debt to income. These are extremely important basic ratios that will determine your eligibility for a loan, regardless of occupancy. And so what I'm going to do is kind of show you the math behind the calculations, so that, again, when you're looking at your own situation in your own private worksheet, whatever you use, you can really understand how these are working. And so again, you can be prepared. So on screen is a fictitious customer called Ken Customer. Ken lives in California, and he's thinking about buying a property. And notice that the LTV up here is blank, and the DTI here is blank. And what that tells me by using this platform is that we don't have any proposed terms for the purchase, and we don't have any proposed terms for how much Ken makes, if Ken has any primary occupancy monthly debt, or if Ken has any other debt, including the subject property. So again, it's education, right? So hopefully you're taking notes. This will be on replay up on the community as soon as possible. And if your loan that you're looking to close on is an owner occupied or a second home, it's real simple. It's just all debt. There's no way to offset this debt. There's no way to offset this debt with any proposed income, because you're not allowed to collect income for qualifying on a primary home or a second home. So when we look at those debt to income ratios, we are going to have a different experience from when the subject property that you're looking to close on is an investment property. Because an investment property, even on a purchase, you're able to use the proposed rent, depending on what your qualifications are. If you're a first-time investor or not, it's going to be a little bit different. Chaley's talked about this in the past. But regardless, we're going to take the proposed income, again, even if the property is vacant, for what's in the property. If the property has a tenant, we're going to use the tenant's lease to offset the proposed PITIA. And if the property is vacant, we're going to turn to the appraiser, and we're going to ask the appraiser, what's the going market rent for the condition of this home as is? They'll tell us. We'll take 75% of that number, throw it into the equation, and see where the math ends. So, the very first thing is, I just saw the smiley face from Eddie, made me laugh. Thanks, Eddie. The very first thing we're going to do is talk about income, right? So when we look at income, first thing we're going to do is again reinforce this concept of when on today's application, when you are documenting your income, it is per employment source. Very, very important, because if your employment source is self-employed, that's going to give us a certain way to calculate that actual that income that we can use for qualifying, versus if you're not self-employed, it's a totally different totally different way. So we're going to presume that on this test job that Ken works at, Ken makes $5,000 a month, and it's W-2, regular pay stub, no fanciness to it, not self-employed, just plain and simple. And I want you to pay attention to this. There's 4 cells here. It's actually 7, but in our case, we're going to focus on 4. And this is called a total debt to income. And the reason why there's nothing before the slash is because in this calculation, we have to look at Ken's primary home. Does Ken have rent that Ken pays? Does he have a mortgage that Ken pays? What do we have? And so when we go through your housing expense for qualifying, we're going to ask, what are you doing today for housing? Again, we have some folks that have no housing expense, and that's totally fine. Some folks get paid to live where they are from their work, especially if they work in the military. Some folks get paid to live, some folks are mobile all the time, so they're traveling for work, so they don't have any primary house. Totally fine. It just is a certain way to calculate your income. So I'm going to just pretend that Ken is going to he's renting now for $1,000 a month. Let's make it 2,000, make it a little bit more realistic, right? Depending on where you live. So now our front end is still blank, and you're wondering, like, what is going on? Why isn't that number changing? And the reason why that number is not changing is because the proposed transaction that we're looking at is a purchase of a primary home. Notice the gross rent is blank and the occupancy is blank because, again, you cannot use rent to help you qualify for primary home or second home. What is important is when we look at the terms of this proposed, we don't see any loan amount, we don't have an interest rate, right? So if we were to come into this transaction and we said, listen, the purchase price is going to be 300,000. Our loan amount, let's say that we're going to be putting down, having Tim put down 20%. So we're going to borrow 240,000. And we're going to have an interest rate, let's just say of 5% today. Have no idea if that's realistic for Tim's qualifications or not. That's not the point. What is important is, again, these numbers keep changing. Now, depending on your occupancy of the home and the purpose of the transaction, we're going to make this conventional also, not VA. So the idea here is if we put 20% down, there's obviously no private mortgage insurance. If it's conventional, you will have mortgage insurance premium for FHA, depending on your term, regardless of LTV. And of course, with VA or USDA, there is no monthly fee. USDA has an annual charge, and the VA just has an upfront funding fee paid once. So it's important to understand what else has to go into this housing expense. Again, I don't know what real numbers are. I'm going to presume it's 200 for property taxes a month and 50 for homeowners. So when we look at Ken as an example, we have a front end ratio that represents $5,000 a month. 30% of that $5,000 a month is going towards the PITIA. And then there's another 10%-ish that's going to other debt. Now, this is why when we look at credit reports, it's very important to understand what is currently an obligation, what is going to be expiring. If it's an installment agreement, like for a car payment, is that able to be not counted against you? Maybe your business pays for it or your employer reimburses you for it. Maybe somebody else is on the note. Excuse me, maybe you're on the note, but somebody else is paying for it. This is all very important information to help make sure that we are documenting your application as accurately as possible. So in this particular case, Ken has got an installment payment for $425 a month, and then a revolving for $44 a month. So keep in mind that if you're the kind of person that constantly pays everything on their credit card, like I do, and then you pay it off each month, there's going to always be a balance every time your statement cuts. And what is on your statement is what's used for qualifying when it comes to revolving debt. So if your own calculations are very, very close, and I'll explain what that means here in a moment, you may want to alter your behavior so that your ongoing statement balances for your credit card revolving debt are next to zero. So there's a myth or whatever going around, it's been around forever, that you get better credit by using your credit card and paying it back. And there can be debates about that. But where there's no debate is that when your credit report is run, whatever that balance is will reflect a minimum monthly payment. And that's what gets used for your qualifying for your mortgage. So if you only have one credit card, maybe it's not a big deal. But if you're in a business of using your cards, again, maybe you're self-employed and you're using your personal credit cards to help your business because you're collecting points or whatever, and now you want to go get a mortgage, if it's personal debt, it's going to be counted against you personally. Even if it's paid for by the business, it can get a little tricky on credit cards, car notes, installment agreements that are paid by the business. As long as we have 12 months canceled checks that the business has been paying that for at least 12 months. Sometimes it even goes out as far as 18 or 24 months, depending on the circumstances, but usually it's a minimum of 12 months. And we're going to use, and we might not have to count that installment agreement against you. But here's where we are. So we've got a 20% down, primary occupancy, conventional loan. Let's pretend the credit is not part of the equation. It's good enough to get the loan. And we have debt ratios of 30% of the housing and 40% of total. This guy's probably getting approved. There is no magic absolute. There's also no magic, no way. But anytime this back end ratio gets above 43, 45, sometimes even goes as high as 50 for owner occupied places. It still might be approvable, but it's really dicey. So when it comes to an occupancy of non-owner, obviously there's more risk involved with that. So this back end number needs to be as low as possible. And I'm going to talk about how we deal with that next. So before I go any further, there's a lot of technical stuff. If you've never seen this, it might even be overwhelming. Are there any questions about from those that are on the call today? Are there any questions about loan to value, how that gets calculated, or debt to income for the housing payment, or total debt? Does anybody have any questions? If so, you can take yourself off mute, or you can use a chat. I'm going to take a sip of water. Okay. I will say that when it comes to the loan to value, again, you'll see three numbers here. These three numbers are for home equity lines of credit. So if you were getting involved with an all-in-one loan, as an example, and you're not drawing the entire line at the time of closing, the middle number will always be less than the two first number and the third number. So this is called loan to value. This is called combined loan to value, and then total loan to value. Again, mortgage technical terms. As borrowers, the only thing you need to worry about is what is the loan to value. If you're purchasing something, it's happened a few times recently, but it hasn't happened in a while. If you're purchasing a property and the appraisal, the final appraised value comes in less than the purchase price, keep in mind that regardless of your occupancy, that loan to value is based on the lesser of the contract price or the appraised value, right? So if you're agreeing to buy a place for $300,000 like Ken, and a place comes in appraised at $280,000, but you still want to borrow $240,000, now it's $240,000 out of $280,000, not $240,000 out of $300,000. So again, keep that in mind as your loan goes through process. Besides getting pre-approved up front, which is what Ridge Lending does on every file, we also want to make sure that once that appraisal comes in, did it come in at value we were hoping for, and is the quality of the appraisal acceptable to underwriting? Those are two big spots. So we're going to go back and change this to a non-owner occupied, and I want to show you a couple of important parts here. So the very first thing we're going to do is change this transaction. Ken decides, nope, he wants to buy a property. It's going to still be a purchase, but now it's going to be an investment property. And right away, I want you to see exactly what happens here. I mean, literally with a single click, the DTI went from 30/40 to 40/80. And you might be thinking, holy crap, like what happened? Well, a couple of things happened. First of all, we still have the housing debt that we told the application, that we disclose on the application, and the housing debt is $2,000 a month. In addition to that, we also have the new mortgage payment for the investment property that Ken is buying, and that is $1,538 a month. So here's where the magic happens. Because even if the place is vacant, you can come over into gross rent. And let's say for this property, just guessing, let's say it rents for $3,000 a month. We use the 1% rule. And again, we use the occupancy rate of 75%. And now we have 35/43. So when it comes to figuring out how you structure your applications with Ridge Lending, or any lender for that matter, if you're purchasing an investment property or you're proposing to purchase an investment property, the gross rents are everything. So when you're working with one of Ridge Lending Group's dedicated lending specialists, it's very important, even if you don't even know where you're going to buy yet, it's very important to understand that the pre-approval that Ridge Lending issues for a non-owner occupied transaction has everything to do with a few things. First of all, how much rent is that property going to generate? That fictitious property you don't even have identified yet. Because if you found a place and it generates $3,000 a month, you're probably okay, right? No guarantees, but you're probably okay. But let's say it only brings in $2,500 a month. Now, I don't know about that one. I don't know. You still might be okay, maybe if you got a lot of money in reserves. But the idea here is that you are less likely to be approved at $2,500 a month rent versus $3,500 a month rent, right? So this is why when you know, if you get asked, if you're making an application, I want you to be, and you're looking for properties. I know we've talked a lot in the community about strategies for purchasing and growing your portfolio and these kinds of things. And the occupancy of the transaction could mean a lot. A good example, literally earlier today, we're working with a borrower and we're trying like hell to get that borrower qualified. They literally don't have a primary home. So I immediately said to the dedicated lending specialist at Ridge, I said, why isn't the subject property going to be an investment? And the answer was because it's going to be their primary home. I said, okay, so they're not planning on renting it out at all. So we're kind of going down that road. And the reason why is because if we're having a really tough time getting them to qualify for this transaction because we're not using any rent. So again, this is not them, obviously, they're not a customer, but the idea is if the transaction you're looking for is possibly going to be an investment property, you can use the rental income. Now, obviously the difference is in a transaction down payment wise for an investment property versus a second home versus a primary, vastly different in terms of down payment requirements, right? Single family, non-owner occupied, you can put 15% down. Typically it's either 20 or 25, depending on how many properties you own and all kinds of other qualifying. But a secondary home or a primary home, you can put as little as 5% down. In primary, you can actually put as little as 3 down if you qualify. So the takeaways here are, when we go to ask these questions, it's not to be a pain in the backside. It is because we want you to make sure you understand that from a qualifying perspective, if it's going to be an investment property or non-owner occupied, is what you'll probably hear more often, how much that property makes, right? That's a 57. I guarantee you're not getting approved. Guarantee it. Even if you love the appreciation model of this deal and it all makes sense, it's just not going to happen. You know, and even if I drop the loan amount down, you're not going to make up that much. The only way to make up that much of a difference in the debt to income is you got to get more income. So, you know, if I put 5,000 here, but the appraiser comes back and says market rent's $2,000 for that property, all you did was waste a lot of money for an appraisal and a lot of time. And you're going to aggravate folks because it wasn't a quality application. We're not going to know how much a place rents for. That's why you're doing your research. That's why we work with agents, so that we can cross-check against what the agents think that the property is going to rent for. Or obviously, if you're with a turnkey, turnkeys absolutely should know what the property is going to rent for if they don't already have a renter lined up for it. These are some of the things that I wanted to share with you today on making sure you understand how as a lender, Ridge Lending, as well as any other lender in the country, how we use platforms like Encompass, as well as other LOS platforms, loan origination systems, sorry. So LOS platforms to help qualify you for the transaction that you're looking for. So coming back to this, I know a couple of people just joined, so some of this might seem out of context, but the point of today was to share with you how we help qualify you for your next transaction, whether it's for a purchase or a refinance of a primary home or second or investment property, and to show you how the debt to income can vary greatly based upon the occupancy, as well as if how much the rent is on the property that you're purchasing. or refinancing. Are there any questions about this scenario or this calculation?
I don't have a question about this particular calculation, but I'm curious to know how does the DTI differ if it's a refi, so investment property, refi, cash out versus just straight refi. And then I'm going to throw one more thing in it. So this is my real life story right now. I need to refi. I need to refi one property that has a hard money loan on it now, and I want to, without cashing out, I just want to refi it, need to refi it. The other property is free and clear. I just want to refi to cash out to purchase something else, hopefully cash. But that property is being renovated right now because my tenant had a fire in the kitchen.
Okay.
So how does, and so the insurance right now, insurance company is paying my rent, but once the property is remodeled, I'm going to raise that rent. So with that being said, and I spoke with my property manager, and the property manager already gave me a number where I could raise it, which is about $215 more than I am getting now. So with that being said, what does the DTI look like? And can I even refi, cash out with a property that is not being rented out right now?
Great questions, Deltrice. Thank you. So I'm going to answer, there's like 3 or 4 questions in there. I'm going to try and tackle these in a logical order from least complex to most. So I'll answer the last one first. And that is you being able to use a new lease value for qualifying on a mortgage on a property that has already been reported on tax returns is not relevant. So in English, if you owned a property for longer, so if you bought a property in 2021, and that would have been reported on your tax returns, they're going to, from a qualifying perspective, they're going to look to see what was the rent collected for 2021 and prorate it appropriately. If it's subject property that you're refinancing, the underwriter will look at the market rent that the appraiser indicates, just to make sure it's within acceptable range, and use that for qualifying. However, you cannot refinance or even purchase a home with a standard mortgage product that is currently under renovation. So even if you got the home renovated, you went and raised the rent on the tenant, and you wanted to cash out refinance that free and clear second home, you can do all of that, but you would not be able to use the extra 200 some odd dollars to help qualify for extra money in the cash out if that's what was holding you back, because you've got no history of receiving that. And that's, from a lending perspective, that's what matters. It's if you've owned it, what have you actually collected? If you're purchasing it, what's the expectation of collecting it? And that's why it goes to market rent, or if it's occupied, what's the current tenant paying? So does that part make sense so far?
It does. And yeah, it sounds like I won't be able to refi that particular property until it is renovated, and then until I start collecting the higher rent, because I forgot there was one other thing. I purchased the property the beginning of January of 2022, and the fire occurred the end of January.
You're okay. That's different now. So first of all, I'm sorry. These are the horror stories of owning investment properties, right?
Right.
You could have been like people I knew, and I'm in New Jersey. People literally bought a house at the Jersey Shore like the day or week before Sandy hit and just destroyed the home. Like, home's gone. So I feel bad for you in one hand, but on the other hand, I have some good news. Because you're an acquisition year, you can use the lease. You actually can use the existing lease for qualifying. Now, you're going to come over here and we're going to say, you know, whatever the new gross rent is on the lease that the tenant is now signed, and we're going to use 75% of that existing lease for qualifying. Make sense?
Yes, it does. I'm taking notes. Thank you.
Yeah, you're welcome. There's a lot going on here. So, so from a qualifying perspective, as a lender, if we are aware that your intention is to close on more than one loan at one time, and you've applied, we are going to treat both transactions as closing simultaneously, because that's what we're aware of. So if you wanted to do the hard money rate and term refi first and not worry about the cash out, we would just simply have to qualify you based upon the lease that you have existing for the fire property. And we would use the tax-based income from the hard money property, and we would put that into, I'll show you this because it's really fancy. We're going to put this, for those of you that have ever filled out a Ridge Lending Group REO spreadsheet, it kind of looks like this. There's a reason, because this is how we figure out, and this only goes up to 12 properties. Obviously, you can have more than that, and it goes into a different place. But the reason why we ask you to complete that Ridge Lending Group REO spreadsheet is because we put it here, and it makes qualifying so much easier. So what we would do is we would fill in over in here, Deltrace, we fill in whatever information we have for your properties. For the properties that were acquired prior to 2022, we would look to your tax return to figure out your gross rental, and we'd figure out your expenses, and then we'd figure out your net income loss from those properties. And for your fire property, we would, the only difference is we would put your gross rental here for the lease, and then we would take 75%, and then again, calculate that net income loss. Is that making sense so far?
It does.
Okay, so your debt to income, yeah, I'm sure I'm going to confuse somebody, so I'm sorry, but I'm just showing you the back end. So what ends up happening is there's a form in conventional financing called a transmittal summary. And in the transmittal summary, what we do is we take your base income from any of your W-2 jobs or your self-employment based upon your tax returns. If the subject property is a non-owner occupied and it's positive cash flow, it'll get added here. If it's negative cash flow, it'll get added here. And like I said in the meeting earlier, your debt to income for both your housing expense for your primary housing, which in this case is $2,000 divided by 7211.63, and then your total obligations is going to add in the 469, which is from the car payment and the credit card. And that's going to be 2469 divided by 7211. Now watch what happens. So if we go back and we remove that rental income, like we talked about a moment ago, and now we go back to our 1008, watch what happens. That cash flow is gone. And now the PITIA is over here because that property has no positive cash flow. And now we have a 40% over 80% because we still have $5,000 base income from that job, but no other income. And now we have total payments of $4,000. So this is how, this is like the magic behind it. If you ever talk to us or any other lender in the world, and they're trying to figure out how to qualify you, all of this stuff, as detailed and maybe even annoying it might seem to like get the finest detail, it's critically important for the math. So going back, Deltrace, just to be crystal clear with you, if we're only looking at the hard money rate and term refi, you'd go on ridgelendinggroup.com, apply, we fill it in. We'd have the REO spreadsheet we can send you in our pipe file link that we send out. And then we would simply add in all your real estate owned, figure out if you're positive or negative, punch in your employment income from any tax returns or any jobs. And then we calculate what your DTI is and your LTV is for qualifying.
Okay, great. And with that, so all of my income is K1 or Schedule C. Do you do a 3-year average, or what do you do there?
25-year average. No, I'm kidding. It's
Oh. Okay.
I gotta make it laugh somehow. No, it's typically 2 years. Whether or not we use 2 years depends on your situation. But we typically say, listen, you've got K1 income, you've got some type of self-employment income from somewhere or real estate income from somewhere. Give us 2 years tax returns. We'll throw it through our analyzer and figure out if we need both years or if we only need the most recent year. Depends on your situation. And the variableness could be if there's a decline in income, we might have to use the lower of the 2 years. If there's a stable or rise in income, we might average them both. It just depends on your circumstances.
Okay, great. Thank you.
You're welcome. Thank you. That was fun. That was fun. Any other questions on this topic? It's wonderful mortgage stuff that you guys probably didn't expect to learn today. Okay. I am not trying to turn you into mortgage professionals, but I do want you to understand the point of doing this is so that you understand when somebody, especially from Ridge, when we're asking for this, because literally 75% or 3 out of 4 clients we help are for investment property transactions. And it's not unusual to have borrowers closing every month with more than one transaction at the same time. Most lenders in this country can't even understand how to do that. They just fall apart. They don't get it. Their people aren't trained. So I'm bragging a little bit, putting a little love on the RLG team because they're super awesome and they really understand how to help out. And also, if you ever come back, we'll make copy files and we do all the heavy lift. So if you have a situation that's as unique as Deltrice's, or maybe not, maybe it's more complicated. We've had situations that are ridiculously complicated, not exaggerating. And so we work through that. It's what we do best. And if we can, we're going to help qualify for everything possible. And I hope this has been helpful and I appreciate everybody coming. Last call for any questions. Eddie, I'm going to test you on this stuff, Eddie. You're always coming to these things, so I always appreciate it. I hope it's been helpful for you. And to everybody else, so I thank you for coming today. If you have any questions about any of this stuff, if you're watching or listening to this in our podcast or on the replay, feel free to post any questions and we'll help you out. Hope you have a great rest of your day, everybody. Thanks for, oh wait, Eddie says, is it possible to get Fannie's spreadsheet? Yeah, you mean like the income calculation? I'll put that up there. I thought we did, but I'll link it to this, Eddie, the 1084. So just to make sure we're talking about the same thing. You're talking about the Fannie Mae, what the hell is that thing called? Fannie Mae income calc. I thought it was 1084. I'll get it for you. I don't know what we put it in here, but yeah, it's an income calc form. Yeah, I'll get that for you on there. You got it. All right, everybody. Have a great rest of your day. Thank you. Bye.
Bye.